today, and the American dream has just been mathematically executed. While the headlines this morning are distracted by political noise, a silent liquidation is tearing through the bank accounts of the middle class. According to federal data released this week, the survival threshold for a comfortable retirement in the United States has officially hit $823,800. Yet, look at the reality. While the average 401k is skewed by the wealthy, the median American retirement balance is stagnating at a terrifying $42,000. We aren't just looking at a gap, we are looking at a $780,000 black hole. A deficit that cannot be filled by saving more or working harder. History doesn't repeat, but it rhymes. And right now, we are hearing the exact same frequency that shattered the world in 1929. We are at stage 5 of the wealth timeline, the moment where the mirage of paper wealth meets the cold reality of systemic insolvency. In the next 20 minutes, we will look past the veil. We will show you why your retirement account is being raided by the very system designed to protect it, and why the golden years have become the greatest financial trap in human history. The anatomy of the mirage. To maintain a standard of living that mirrors even a basic middle-class life in 2026, you now require nearly $1 million in liquid assets. This is not a temporary market fluctuation. It is a systemic endgame where the math simply stops working for 92% of the population. To understand the trap, we must listen to the rhythmic vibration of the ticker tape machines in 1927. Back then, industrial pensions were sold as a permanent shield. Companies like U.S. Steel promised security in exchange for 30 years of labor. Americans stopped saving gold and started trusting corporate ledgers. It was a period of frantic optimism, blinding the public to the reality that these pensions were unfunded liabilities. The smell of fresh ink on worthless stock certificates defined that era, much like the digital glow of the 401k dashboard defines ours today. By 1929, leverage reached terminal velocity. The rusty bolt of history was turned again in 1978 with Section 401k. This tax tweak moved the entire risk of the wealth timeline from billion-dollar balance sheets directly onto your kitchen table. We replaced guaranteed safety with a volatile casino, and for 40 years, the upward march of asset prices hid the structural rot. The escalation hit a breaking point during the inflation surge, leading us to 2026. As a gallon of milk hit $6.50, the silent raid began. In the last 12 months, hardship withdrawals increased by 22%. Families are burning their future to survive the present. This is the math trap. The yield on the 10-year Treasury note, the supposed bedrock of safety, is now locked in a zone of negative real yield. Even if your account shows a green percentage, after accounting for real-world inflation, you are losing at least 4% of your actual purchasing power every single year. You are running up a down escalator that is accelerating. We are now at the apex of the silver tsunami. Every day in 2026, 11,000 Americans turn 65. For the first time, the majority enter retirement with more debt than equity. They see numbers on a screen that look like wealth, but those numbers buy 40% less than they did in 2021. The exit door is 36 inches wide, and there are 70 million people rushing toward it at once. The collapse and the shadow winners. As the first quarter of 2026 unfolds, the Great Liquidation is no longer a theory. In 1929, the chaos was physical, padlocked bank doors and bread lines. Today, the chaos is digital. It's the frozen button on your brokerage app during a high-volatility window. It's the 48-hour delay in your 401k distribution because the underlying bond fund is facing a liquidity mismatch. But in every collapse, there are shadow winners. In 1929, Joseph P. Kennedy moved into cash and short positions before the slide. In February 2026, the pattern is repeating. The top 0.1% have already rotated out of retail retirement funds. They have moved into hard liquidity, private credit, physical gold, and sovereign-resistant assets. The modern warning is flashing in the debt trap. As of today, the U.S. government is spending over $1.2 trillion annually just on interest payments. This isn't just a stat, it's a ceiling on your future. Taxes must rise to service this debt, eating your dividends and your legacy. The verdict for 2026 is harsh. The era of passive, set-it-and-forget-it retirement is dead. The S&P 500 cannot be your only plan when the currency it is priced in is being liquidated at the rate of $100,000 in purchasing power every few years. The legacy of this moment will be the Great Bifurcation, a world where those who understood the historical cycle secured their lineage, and those who trusted the pension mirage were left with nothing but digital receipts for a dream that no longer exists. Check your statements. Look at the real inflation rate. The clock is not just ticking, it's accelerating.